Good evening, ladies and gentlemen, and welcome to the special committee of the whole meeting of the DeKalb City Council, August 21, 2018. Prior to our roll call this evening, I'd like to ask anyone in the audience who would like to participate in public participation to do so in just a moment or two. Otherwise, we will move through the three considerations of the meeting tonight. And prior to our roll call, I'd like to welcome in her first official duty our new city clerk, Lynn Fazekas. Lynn, welcome. And I'd like to also welcome Ruth Scott, Deputy City Clerk, who has been doing the yeoman's job of our city clerk duties over the past several months. And so I think you're going to be seeing Ruth and Lynn sort of in tandem here over the next several meetings while Lynn gets the lay of the land, if you will, of city clerking, if you will. So with that, I'd ask Lynn to call the roll, please.
Here.
Marquardt.
Here.
Fagan.
Here.
Pareko.
Here.
Burbank.
Here.
Faber. Smith.
Here.
6 present.
Thank you. For the benefit of our city council, Dave Jacobson is on vacation and obviously will not be here, and Tony Faber had indicated to me late last week that he was going to be traveling out of town and not able to join us for our meeting tonight. I'd also like to call attention to the fact that our interim city manager, Molly Talkington, who also is our finance director, is with us tonight, and she will be shepherding us through this meeting along with her associate, Bob Miller. So let's move right on to considerations, unless there are any public, if there's any public participation. Anyone in the audience care to say anything? If not, let's move to consideration number 1, and that is the FY 2017 Comprehensive Annual Financial Report, Audit Report, and Management Letter. And who'd like to address that? Bob? Bob Miller.
Good evening, Mayor and City Council. For our first presentation this evening, I have Brian Lefevre here from C.O.W, who is our auditor, and he'll be presenting the 2017 Comprehensive Annual Financial Report.
Thanks, Bob. Good evening. On behalf of C.O.W, I'd like to thank the Mayor and the members of City Council for inviting us to present some comments for you on the report resulting from the audit of the city for your year ended December 31st, 2017. It's called a Comprehensive Annual Financial Report. And the reason it's a Comprehensive Annual Financial Report, it's over and above what's required under statute for an audit of a local government in Illinois. In Illinois, you'd be required to have a financial section, which would be an annual financial report. What makes it comprehensive is the introductory section and then also the statistical section as well. So within the Comprehensive Annual Financial Report, if we go to Roman numeral 3 inside the introductory section, and give you a second, I know you're following along electronically, this is the award that the city received for its 2016 6-month period from the Government Finance Officers Association. It's the Certificate of Achievement for Excellence in Financial Reporting. And this is 24 consecutive years that the city has received this award. It's the highest level of financial reporting within the local government industry. You should be all be commended for this. In addition, the city also has been receiving the award for its budget. And then also has prepared a popular annual financial report, which is basically a streamlined version of the CAFR for your constituents. If you turn from there over to the financial section of the report, the first page in the financial section you'll find to be on C.O.W letterhead, because this is where we've given an opinion on the financial statements. It's page number 1 of the report. In order for us to give an opinion on the financial statements, we're required to follow 2 sets of standards. One set of standards are the auditing standards issued by the AICPA, which tells us the types of procedures that we need to perform when we're conducting our audit. And the second set of standards are the financial reporting standards issued by GASB, the Governmental Accounting Standards Board, which tells us what the CAFR needs to look like, this document that we're going through. Once we follow those two sets of standards, we can then issue an opinion on the financial statements. We're pleased to present an unmodified opinion, and what that means is that the financial statements present fairly in accordance with generally accepted accounting principles, free of material misstatement. And this is the highest level of opinion that the city can receive on its financial statements. You'll also note on the third page of the independent auditor's report, the last paragraph references other reporting required by government auditing standards. What that reference is to what's called the single audit. Anytime that the city expends more than $750,000 in federal funds, you're required to have a separate single audit of those grant funds. During the fiscal year, the city expended just under $1.8 million in federal funds, and 2 opinions were issued related to in the single audit as required by the federal government. The first was an unmodified opinion on laws and regulations that could have a material impact on the financial statements. And then the second was an unmodified opinion on compliance with the major program we tested during this period, which was your mass transit grant. So more good news there. Finally, you'll also have received a separate TIF compliance reports for your tax increment financing districts, and we also issued unmodified opinions on those financial statements, along with an unmodified opinion on compliance with the legal regulations surrounding the TIFs. And I know those then go to your joint review board, and also to along with the reporting to the state comptroller's office. Just past the independent auditor's report is page MD&A 1, which is the management discussion and analysis. It's its own separate page numbering because the city prepares this and it's inserted into the comprehensive annual financial report. This serves as the executive summary. It is required by those GASB standards, and then it's our job to review it to make sure it's consistent with the GASB standards and also with the financial statement presentation. It's the one place in the financial statements that you get to, as the city, be able to give some of the reasons why behind the financial statements. Now, in this particular year, it's a little more confusing because you're comparing a 6-month period to a 1-year period. So once we start to get more December 31st cycles, it'll be easy to see those trends. But I would encourage you to read this document if you don't have a chance to go through the entire CAFR. The management discussion analysis goes for 13 pages. After those 13 pages, you come to the first audited financial statement, which is called the Statement of Net Position, and it's on regular page number 4. I like to refer to the Statement of Net Position and the Statement of Activities as a global view financial statement. Basically, it takes all the funds that you budget and appropriate for and rolls them up onto one financial statement, and for your governmental activities, it layers your capital assets and your long-term liabilities. This is what's called the full accrual basis of accounting. The long-term liabilities include the net pension liability for your IMRF, police, and fire pension plans, and therefore this causes your unrestricted net position for governmental activities to be negative. And this was a requirement that came from GASB a few years ago, requiring those liabilities to be reported on your financial statements. If you turn from there over to page 10, page 10 is the operating statement or income statement for your governmental funds. And if we focus on your general operating fund, this shows the revenues, expenditures, and changes in fund balances for the year. If you look at the middle of the page, revenues over expenditures for the year were $1.2 million. After the budgeted transfers in and transfers out to other funds, overall you had a decrease in fund balance of $155,000. You started the fiscal year with fund balance, or reserves, if you will, of $9,229,000. finishing the year at $9,073,000. You were just short of your 25% policy, which is your actual expenditures, including transfers, to have reserves covering at least 25% of that, and you were just shy of that, so right around your benchmark. If you turn from there over to page 15, we'll see the operating statement for your proprietary funds, namely your water, airport, and refuse funds. If we focus on the water fund, you'll note that the overall water fund had an increase in its net position, 3 lines up from the bottom of the page, of $469,000. The airport fund also had an increase from the year, noting that you had significant grant dollars go into that fund during the year, and also you now have the home rule motor fuel tax going into the airport fund as well. So while you had an increase in overall net position, from an operating standpoint, your expenses exceeded your revenues. The last operating statement to bring to your attention is on page 19. And page 19 is the operating statement for your police and fire pension funds. And you can see separate breakouts on all of the funds in the back of the report, including for your police and fire. It's separated on pages 137 and 138. So what we see on page 19 is just the consolidated police and fire pension plans. So if we look at that, we see that that the city contributions is what's labeled employer contributions, just over $5,453,000. Active member contributions from active police officers and firefighters that's required under statute totaled $1.1 million, so $6,554,000 in new monies into the plan during the year. Net investment income was $7,431,000, so your overall revenues were $13.9 million. Your expenses were $6.7 million, mostly obviously in paying pension benefits, and that left an increase to the plans combined for the year of $7.2 million. So at the beginning of the fiscal year, you had $57,270,000, and at the end of the fiscal year, $64,512,000. For a little bit more information about the health of the pension plans, not so much from an actuarial point of view, because you'll be hearing that on your next item on the agenda, but more from a health of the plan. If you turn to page 85, also have IMRF information as well. So if you look at page 85, you can see we're building up to a 10-year schedule on these schedules under the GASB rules that came into effect a few years ago. And you can see for December 31st, 2017, the budgetary impact of the city contributions for IMRF was just over $1,120,000. You can see that's exactly equal to the actuarially determined contribution, because each and every month you're required to pay that contribution rate that IMRF's actuaries have stipulated that you must pay each and every month, and that's a statutory provision. You can see that was 15.3%, lower right corner there, of the payroll for the year. Which is often a measure of your contributions relative to the payroll for those participating in the IMRF plan. If you turn to page 86, you'll see similar information for the police pension plan, and you can see that the contribution that was made for the fiscal year for the police pension plan was $2,485,000, just a little bit shy of the actuarially determined contribution, but 42.6% of payroll. And then on page 87, you can see the fire pension plan also made just a little bit less than the actuarially determined contribution, with a contribution of 58.2% of payroll in the fire pension plan. So that's one piece of looking at the health of a pension plan, is did we put in what the actuary recommended we put in, and then we can actually look at the financial results themselves. So if you turn to page 88, so page 88 shows you fiduciary net position, which is basically saying assets at market value, and Heidi's going to tell you about actuarial value of assets and how you fund based on actuarial value. Otherwise, if you had to fund based on your market value, then your funding would be like this. She's going to tell you how that smooths things out. So IMRF, if we look at IMRF, December 31st, 2017, when we talk about the total pension liability, that's all your active employees and your beneficiaries. The actuary projects what those expected payments are going to be over the life of those individuals and present values them back to December 31st, 2017, and that's what we're talking about with the total pension liability. 56.1 million is that first double underscored number. The assets set aside is GASB's fancy way of saying the planned fiduciary net position, 52.8 million, so you had an unfunded liability of only 3.3 million, and the IMRF plan was 94% funded at December 31st, 2017, up by 11% from the prior year, with a really banner investment performance during 2017. If you look at the police pension fund information on page 89, you can see that the net pension liability was 35.6 million. Your funded percentage went from 47.9 to 49.7% based on those market value of asset numbers. And then finally on page 90 is the fire pension information. Your net pension liability there was 42.5 million. Your percent funded went up from 39.1 to 40.8%. So the last schedules I would bring to your attention are then we're starting to build these same trends for investment returns for police and fire pension. You can see that for the fiscal year 2017, that the police had a 14.21% investment return. And then on page 92, a 12.26% return for the fire pension plan. Those were the comments I had prepared for you this evening. In conclusion, the audit went very smoothly. We did receive all the information that we needed on a timely basis. You should also know that you have very professional staff, not only in finance, but in all the departments, as we work with all the departments, especially as it relates to your grant activity, and also getting input from both the City Council and also all of the staff related to our risk analysis, and definitely very easy to work with your staff. With that, I would be happy to answer any questions that you might have.
Any questions from council? Alderman Noriko.
I noticed that regarding the library, there was a note that there's still an outstanding deficiency. And, you know, if you can comment on, or Bob can comment on working with the library in terms of taking a look at their financial operations. I have concerns, especially after we face the tax rebate issue, transparency in the library's financial operations.
So we're in a different document now, right? Not related to the comprehensive annual financial report?
It's the library letter.
Okay. So yes, there are recommendations in the library management letter.
Mm-hmm.
So there were certain adjustments that we needed to assist them. I know they had a new accountant helping them with the audit this year, and there were some items that we needed to assist them with for their financial statements to be in accordance with generally accepted accounting principles.
And a couple of, I think, of the specific points, Kate, if you notice, said it has been completed.
Mm-hmm.
Right, there were a couple of comments from the prior year. Yep.
There
There
was at
one.
least
One
one
in
that was still
particular,
hanging
right.
there.
Yeah.
So I don't know if there's anyone here from the library, so I don't know what the library is doing related to these comments.
I don't know if Bob or Molly can address that.
Kate, which one was it that was the ongoing one? Because I know the property taxes and the year-end cleanup we've addressed. It was really mainly due to their staff turnover, so we've worked with them to hopefully correct that going forward.
The only comment from the prior year was the interactive account groups for long-term fixed assets and long-term debt. So,
yeah, in those cases, that will be the library board with library staff working forward to address how they would account for that. I think that'll be a matter of time with them getting more in tune with their current accountant and staff that's at the library. I think a lot of the issues that occurred this year were in the turnover in staff. So if you remember at the library, they had a long-term person who was their office manager, but also their finance person. That position turned over, and the person they hired is more of a office manager, so she's learning that financial function that was within that role. They had a long-term contract with a different accountant than they have now, and that contract turned over to a different company. They've switched financial software that they're using for the library, so they've not only switched the accountants, they switched software, and they're trying to work through bringing the old information into the new, and now we're working with them to bring their accounts in line with the new accounts that we're going to have at the city. So some of the account numbers will have similar, so if we have an account number and they're broken down in different segments, so certain things will indicate that it's the library, but then the last segment might just be office supplies. We would use the same account number for our office supplies as they will for their office supplies. So we're trying to work with them to streamline that we're on the same page with the account number structuring. And I know that Emily is working, the library director, she is working to kind of adjust some of her budget line items so they fit in better kind of accounts for how she feels that they would work, and she's working with the library board on that. But addressing how they're going to account for fixed assets and the long-term debt is what she needs to work out through with her accounting firm and the library board, and how they want to rectify that deficiency and how they'll organize.
Do you have reasonable comfort that they have the right people in place that they can move forward? Because I recognize that turnover does impact continuity, but I would hate to see deficiencies carried through year after year.
So my concern is similar to yours. They have new staff, and some of the things that were noted on their management letter seem somewhat basic in the accounting functions that should have been accomplished, like recording, I think, their property taxes in the correct accounts. I do think that'll get fixed going forward, but there's going to be more continued conversations between myself and the library director, and working through how she's putting together her budget and how to prepare the property tax levy. So we do have some of that. It's more of a reliance on the city to assist the library than I think there had been in previous years. So there's more work on our end than we've typically done, and there's as they're working through figuring it out, we've spent a lot more time kind of double checking their figures and correcting information for them, so in hopes that the next year we come to audit, we won't receive those comments on the library side again.
I see
catch
three.
it ahead of
Yeah,
time.
I see three component pieces here. Frankly, one is the fact that the question is well placed and duly noted, Kate. It was a good question, and we should ask that question given the scenario that has played out here over the past year with the library and the rebate issue and the abatement issue at all. The second component piece, in my opinion, is the fact that the auditors did take a look at the library as a separate entity, as it should, and there is a special relationship between that library board and the city of DeKalb. While I didn't like the deficiencies, there were some explanations as to what needed to be done to fix those deficiencies, if you will. The third piece, and perhaps as important to me as the mayor, is the fact that our finance director, Molly Talkington, and the executive director of the library, Emily Faulkner, have in fact worked together more closely. And frankly, Molly has said to me, we need to work with the library more closely from a fiscal point of view. So I commend the library and Molly on that. I commend C.O.W. for doing this as a separate piece. And Kate, I appreciate your question, because it is one that certainly is very germane to us moving forward. You know, it's nice to get the awards, it's nice to get the certificate of appreciation, it's nice to get that clean audit, and believe me, I'm happy that we did get a clean audit, but I think some of these auxiliary, ancillary pieces need to be asked. So I appreciate that. Any other questions? Or comments? None? Okay, Brian, thank you.
Thank you very much.
Appreciate it. Are we ready to move along to consideration 2, Bob?
Yes, we are.
And that is actuarial reports for police and fire pension funds.
And with us this evening is Heidi Andover. She's here from Foster & Foster, and she will be presenting both the police and fire pension reports.
Very good. Heidi?
Thank you very much for allowing me to walk you through the results of this report. I'm focused tonight on the police and fire pension reports specifically, and because Brian did go through the accounting side of things with you with respect to the pension funds, I'm going to be focusing on the recommended contribution amounts for both funds. And so with that, if you turn to your reports, starting with police, if we flip to page 5, this is sort of our bottom line on top page. And this will provide you with a summary of the numbers from last year compared to the numbers this year. And you could see that there was a pretty significant increase from the prior results that we delivered and recommended to this year of about 15% for the police pension fund. The results were really driven by a few factors. The biggest one was that we did make an assumption change this year that increased the liabilities. And I'll go through that in another page or so to walk you through some of the assumptions that we did change year over year that we think will better predict the liability pattern of the fund. In addition, there was some unfavorable experience year over year. So what we do is we look at what happened over the course of the year and compare that to our expectations with respect to what retirements we thought would happen, what terminations we thought would happen, disableds, things like that. We look at that compared to what really happened, and that will determine whether the plan experienced a gain or loss with respect to all of those assumptions. And in this case, there was some losses for those. And then in addition, there is a natural increase in your contribution every year by the nature of the methodology. So there's a payroll growth assumption that is employed in the valuations. And basically what that says is every year you're going to pay a little bit higher payment on your amortization of the unfunded than you were the prior year. So you're sort of guaranteeing an increase in the contribution just by the nature of that methodology. That's a methodology that's used across the state on all of these funds, so it's not something that you should be alarmed by any means, but it is something that does happen with this methodology. You will see that increase year over year. Okay, so with that, let's flip to page 7. And on page 7, you could see the list of changes that we did make year over year. So the biggest change, and what's driving the results the most here, is really this interest rate assumption change. So last year we were using a 7.5% discount rate. We've dropped that by 50 basis points down to 7%. At the 7.5% rate, you were really on the borderline outlier area there. I'd say at the 7% rate, you're on the higher end of a lot of funds. A lot of our funds are at the 6.75, 7% range. That's more typical, but at 7.5%, we were feeling a little bit uncomfortable with that interest rate, just because it was getting to be pushed to the outlier range in light of the predictive assumptions of your investment advisors. So we do look to what the investment advisors are suggesting long-term. The plan will be returning based on the investments that they target and the long-term expectation of the returns on those various investment classes. And looking at that, the 7.5% felt high, but we feel much better at the 7% rate. That did increase liabilities, however. At the same time, we did make some assumption changes to those demographic assumptions I mentioned. So retirement rates, termination rates, disability rates, and those were triggered by a assumption study that was performed at the Department of Insurance level. So every 5 years, the Department of Insurance does a assumption study on Article 3 and Article 4 fire and police plans to figure out what the past 5 years of experience on retirements has looked like, and disabilities has looked like, and terminations. And so we took the experience that they have leveraged across the state on all of those separate kinds of funds and consolidated those and used those for your fund as well. There aren't many funds that are big enough to have their own study done. They just don't have enough lives to say this many people retired age 50, 55, etc. And so as a result, we do lean on those tables quite a bit. That being said, we do use our software to compare your actual experience to what those tables are suggesting and see how your experience has performed every year relative to each of those assumptions. So to the extent that we saw something that deviated significantly, we would raise that as something that we'd want to consider updating. But generally speaking, the patterns have followed pretty closely to what the Department of Insurance tables have suggested. And because there was a newer table, the prior tables were from 2012, these were from 2017, we did update those to something more recent. And so that generally decreased the liabilities, actually. Not as much as the increase from the interest rate change, but it did help a bit. And then the last big assumption change we made was that payroll growth assumption I mentioned. So the idea of this payroll growth assumption is it's solely used to amortize the unfunded liability. So you know that your assets don't cover the total liabilities of the fund. Brian mentioned that when we were talking about the accounting numbers, you're funded at the 40% level or so. And so looking at that 60% unfunded, we need to have a payment to pay that piece down. And in the calculation of that, we use what's called a payroll growth assumption. And basically what that's saying is every year we're going to increase the amortization by whatever that payroll growth assumption is. So when we were saying the payroll growth assumption was 4.5%, every year we were saying the amortization would increase 4.5% from the prior calculation. We've dialed that down to 4%, but what that means is we don't expect that amortization payment to increase as much in the future, so as a result we have to have a higher payment today to pay down that same liability over that time frame. So the lower payroll growth assumption actually increases the contribution requirement. Okay, so with that, let's turn to page 9, just to focus on the funded status on a contribution basis. Now, a couple things about the funded status you'll see at the bottom of page 9. The funded ratio here is based on the actuarial value of assets, and as Brian had mentioned, when you're looking at accounting numbers, you are looking at market value of assets. Accountants don't tend to like smoothing methods, but when we're looking at calculating an annual contribution, we don't want to introduce unnecessary volatility. So to the extent that you have a really good year or a really bad year, that market value volatility would make your contribution sort of bumpy. And rather than introduce all of that volatility at once, what we do is we smooth those gains and losses over a 5-year period. And so your actuarial smooth value of assets is what we're using here to determine the funded ratios that you see on page 9. And you could see that last year you were at 50% in the police fund. Had we made no changes, that middle column there, the old assumption line or column, will show you what the number would have been had we not dropped that interest rate, had we not made those changes to the decrements. And you could see your funded status would have improved slightly, almost to 1%. However, when we introduced some of those assumption changes, it did move back down to the 48.7% level. So that did hurt the funded status a little bit year over year. Okay, if we look at page 11, page 11 gets into the meat of the calculation of the contribution, the recommended contribution. And you can see last year on the far right, we have the recommended contribution amount from the prior year of about $2.7 million. That was about 49.5% of payroll for the police department. Had we not made any assumption changes, the number would have been $2.8 million. However, with the assumption changes that we introduced, it's about $3.1 million that we recommend to fund by the 12/31/2009 fiscal year end date. The components of that contribution are really a few things. If you look at the top column under the new assumption column, if you look at the top of that column, you can see there's a $1.3 million labeled as normal cost. What normal cost is really 1 year's worth of accrual for your police officers to earn benefits in the fund. So by working 1 more year, having 1 more year of service in the fund, that is what the value of working 1 year for the whole department is worth, the $1.3 million. Now they pay part of that $1.3 million. So in the expected member contributions row, you could see that they pay $577,000 through their member contributions. So they're covering some of the cost of that 1 year of benefits. But the difference is what the city would be funding. In a perfect world, the city would fund that number plus the next one down, administrative expenses of about $40,000. That's just the cost of administering the fund every year in terms of all the expenses that are required to maintain that fund. In a perfect world, that's all that's being funded. No fund is funding just that, because everybody does have this unfunded component that they have to pay down. If you think of it like a mortgage on a house, you have to pay this debt down over time to get to the 100% funded level again, just so you're keeping pace with what benefits have already been earned. And that's the middle number here of the basically $2.3 million in that new assumption column. About 75% of your contribution is just paying down past liability accruals, past benefits that have already been accrued in the fund. So the good news is once that's paid down, your contribution goes down quite a bit. The bad news is that's 23 years out. So it is quite a while. That's typical of most funds as well, though. So nothing to be alarmed by, but it is a while before you see that number go away. Okay. Fortunately, if you look at section F at the bottom, we are happy to see this, and Brian suggested the same thing. The city is funding pretty close to the recommended amount that we've been recommending here in the fund. Assuming that trend continues, you'll see your funded status improve over time, and the situation will look better over time. So that was good news to see on that page. So if we flip to page 12, the only thing I really want to point out here at the top of page 12 is in section H. You could see that there's a schedule that shows you the projection of that unfunded, that amount that you do need to pay off over those 23 years that I mentioned. And that projected unfunded actually is increasing in the short term. And the reason that's happening is due to that payroll growth assumption. Because the $2.3 million, that's 75% of your contribution, is not even covering interest on the annual increase on that pay down. So if you think of it like the mortgage on your house, when you pay a mortgage, part of the payment you make every month is going towards principal to pay down the mortgage, and part of it's going towards interest that the bank is earning. And over time, more is going towards principal, less is going towards interest. What's happening by the nature of using a payroll growth assumption is that you're pushing some of the payments out into the future by saying, okay, today maybe the payment's $1,000, then next year the payment's $1,040, and the next year the payment's $1,080, and so on. By saying that you want a lower payment today and you'll trade that for higher payments in the future, your payment today is not even covering the interest. So you're accumulating that additional interest as part of your debt in the short term. So it takes 8 years to overcome that. So in the next 23 years of amortization, the first 8 years, we'll see this negative amortization, assuming that our predictive assumptions have come true. So the lower the payroll growth is, the faster that negative amortization ends, but it is important to understand that with respect to the payroll growth assumption. So if we flip to page 14, kind of continuing on that trend of the payroll growth assumption, what I want to point out here is we did drop this assumption by 50 basis points this year along with the interest rate. And so when we calculate the 23 years of amortization at the beginning of the year, and the numbers that I showed you before had an interest adjustment because we know the timing of these is not a 1/1/2018 payment. We do adjust them when we calculate the contribution. But if you look at that beginning of the year calculation, you could see the amortization amount on page 14 shows you the numbers at $2.1 million. That's at the 4% payroll growth level. To show you the power of this assumption, if we drop that down to 2% payroll growth, which means that in the shorter term you're going to have higher payments, but longer term they won't increase as much, that would increase your contribution today by $426,000. So it's pretty painful to move that assumption too quickly. If you drop that down to 0% payroll growth, so exactly like your mortgage is amortized, there's no payroll growth concept. You pay the same number every single year. So a 0% payroll growth assumption on this number would increase it by $899,000, about $900,000 today. Now, over time, that means your later payments would be lower, but it's a pretty hard number to stomach in the short term. But I just wanted to let you know that that's what that assumption is doing. So if we look at page 16, page 16 will show you the contribution of the reconciliation, the contribution from last year to this year. And I just want to show you the big ticket items that are contributing to that. So I mentioned last year we recommended the $2.7 million at the top. And as you look through the items here, the big ticket items are, one, that increase in the amortization payment due to the payroll growth. So basically every year you're committing to about another $84,000 increase in the payment. So if all else equal, everything that we predict comes true, you can expect your contribution to increase by around $80,000 or so every year. The second thing that really impacted this year was this assumption change line, and that did increase the contribution year over year by over $250,000. So that was a pretty impactful one, and that's mostly driven by the 50 basis point decrease in that interest rate. Okay, if we turn to page 18, on page 18, what I want to point out to you is this is the projection of the benefit payments of the fund. So if all of our assumptions come true with respect to the timing of retirement, with respect to mortality, all of the decrements that we've predicted, all of the assumptions we've made with respect to how salaries will increase for the population, how service will be earned for the population, if everything comes true, on the current population, this is assuming no new entrants, but on the current population, this is the benefit payment projection we can expect. So if you look at the total payment column on the far right, the numbers I like to focus on are looking at the 2018 number. About $3.2 million of benefit payments are expected to happen in 2018. And what I like to do is compare that to your market value of assets. And in your case, it is about 9% of your market value of assets. So from that perspective, I actually feel like you're in a pretty good place. I've had funds where this number is north of 25 or 30% of their market value of assets, and those funds have a lot to worry about. In this case, the fund has some time to invest, and there's no immediate liquidation issues to be concerned about here. So 9% is a pretty good place to be. The other thing I like to see is how long does it really take that number to increase dramatically, and it's about 13 years out before it actually doubles. So it's a while before we'll actually see that payment on this population double. So again, supporting the idea that you have some time for the money to work for you at least. In terms of what's getting invested. Okay, so let's flip to page 24. On page 24, this does show you the actuarial value of assets, so it does walk you through the smoothing methodology and the 5-year smoothing. I'm not going to get into the details of that calculation, but they are here if you wanted to look into that. But what I did want to point out is that because we smooth, we're telling you right now you have a loss due to assets. And the reason you have a loss is because we're smoothing in some losses from the past that are sort of mitigating some of the gains that you've had shorter term. And so the actual value, the actual asset rate of return is 6.92%, which is shy of what we expected last year, 7.5. However, as Brian mentioned, you did have a very good year in this fund from a market value perspective, and hopefully that trend continues and you can continue to see those gains, which will eventually show up in your actual value of assets over that 5-year period. Okay, and then let's flip to page 26. Here we get into some of the statistics of the fund in terms of population, and here you could see we have it broken down at the top into your actives. Actives are split into tier 1 and tier 2, and the only difference between these tiers is the benefits that are promised to the various tiers. So in 2011 there was a change made to introduce a new tier, and anybody hired in that after that 2011 date is in tier 2, and the benefits in tier 2 are not as rich as tier 1. So you could see 46 folks are in tier 1 as of January 1st, and 18 are in tier 2. So that's about 28% of the population. As you see more tier 1s leave and more tier 2s be introduced to the fund, that normal cost number that we talked about earlier, that benefit accrual, will come down because they earn benefits at a slower pace. They're still contributing the 9.91% of pay, but their benefits are being earned at a lower rate than the tier 1s. So that will help that situation. Okay, and then lastly, let's turn to page 27. On page 27, what this shows you, it's an aged and service distribution of the fund. It buckets the active population as of January 1st into the various age and service buckets that they currently fall into. And what I like to do is focus on the bottom right corner of this chart to see who could retire right now. I think this helps from a workforce planning perspective as much as anything, but it also helps to understand how quickly those benefits are going to start accumulating and drawing out of your fund. Right now, there's only 6 folks that were eligible to retire as of January 1st, which is about 10% of the population. And within 5 years, if you back off another 5 years, anybody over 15 years of service, anybody over age 45, basically, there are 13 more folks that could retire. So in total, 19 folks that could retire in the next 5 years. About 30% of the population. Might sound kind of startling. I've seen plans where this is north of 50%. In your fund, this is a pretty typical place to see the numbers, and again, it shows that we're not going to see huge draws on the fund in the short term because of lots of retirements coming up. Okay, so that was the police fund. Any questions there before we move on to fire? And I can go through fire a little bit more quickly. It's similar. Oh, go ahead.
You said that you smooth out the investment experience. How many years back do you go? And
we reach back 5 years. It's a 5-year period. And actually, if you look at page 24, you can see what we've called gains and losses over that past 5-year period. Those gains and losses are relative to the assumption, not the pure investment gain or loss that your investment advisor would bring to the table, but it's compared to this is what the fund performed in terms of gains and losses. This is what we expected it to perform, and the difference between those is what we're calling the gain or loss.
Okay, thank you.
Any other questions? All right, let's go to fire. So fire, again, let's flip to page 5 of the fire report. The same layout, same everything, so I won't have to go into all the detail here, but just to show you the differences. Here we can see a 10% increase in the contribution year over year. It's a little bit less than the police was. The police was at 15. But again, the same things are driving this. The change of assumptions is really the biggest one. Again, we did make that 50 basis point change. And then that amortization payment methodology, we're going to see that increase every year just by the nature of that methodology. Okay, so if we flip to page 7, this just walks through the various assumptions that we did change. So as I mentioned, the 50 basis point drop in the interest rate, we again updated the various decrements to use the 2017 experience, and then that payroll growth assumption was the other 50 basis point drop that increased the contributions. If we flip to page 9, you can see the funded status here. For the fire plan, it's a little bit less well-funded than the police. Last year, you were at 41.1% on a funded status on an actuarial funded basis. The middle column, had we made no changes, you would have moved up to 42.6, so that would have been a significant increase. However, with the assumption changes introduced, that dropped down to 40.9. So you ended up at a pretty similar place to where you were last year with those assumption changes being included. Okay, if we flip to page 11, getting into the detail of the calculation of the contributions, again, in a perfect world, we would contribute, looking at that far left column, $2.3 million of normal costs. That's the accruals of the fund. We'd add to that the administrative expenses of $35,000. Add to that the amortization on that unfunded of $2.7 million, which is about 76% of the contribution that we're recommending. The sum of those three numbers gets us to about $4 million, and then we get to reduce that by the expected member contributions to end up at the expected city recommended contribution of $3.5 million. Had we not made any assumption changes, you could see that would have been about $3.259 million, but with that assumption change introduced, it did increase things a bit. If we flip to page 14, on page 14, again, looking at that amortization payment calculation, at the 4% payroll growth assumption, we're predicting an amortization amount at the beginning of the year of $2.5 million. If we drop that down to a 0% payroll growth to amortize that like a mortgage, that increases this by about $1 million. So in the short term, that's a pretty painful number to move to, but ultimately, the lower the payroll growth assumption, the more pain today, the less pain in the future. So that's always a trade-off to consider. Okay, page 16 will show you the highlighted numbers that really increased the contribution year over year. So last year, we recommended $3.2 million contribution at the top. And you could see the items that increased that the most, that increase in amortization payment due to the payroll growth assumption of about $100,000. again, that's an annual thing that we'll see. Because we have a payroll growth assumption, every year we expect that payment to increase the contribution a little bit more. And so you could expect that the payment will increase by about that amount every year if all of the other assumptions come true exactly. But we did introduce some assumption changes this year, and that increased the number by just shy of $250,000. So those were the big drivers of the changes year over year. If we flip to page 18, this shows us the projection of benefit payments again, but this time for the fire fund. And looking at the 2018 total payments, the very top right-hand number is of $3.5 million. That's about 12% of your market value of assets. So a little bit more than we saw in the police fund, which was at 9%, but still not at any alarming place from the perspective of having to liquidate funds to make sure benefits can be paid. And in this case, the fire fund takes a little bit longer to double, so it's 16 years out before you actually see that payment double. So the increase in this is a little bit slower than what we did see in the police fund. If we flip to page 24, so again highlighting that investment performance at the bottom, as Brian mentioned, you saw market value of assets that exceeded a 12% return. However, when we smooth that at the top here, the gain-loss table at the top, you could see where we've had gains are positive, where we've had losses are negative. There's still some losses that are being smoothed into the actuarial value of assets, and therefore it sort of mitigates that return for the year, and we actually saw a loss on the actuarial value of assets because the assets performed at 6.73% after the smoothing was introduced. And then let's flip to page 26. Now we're getting again into the statistical data of the population of the fund. As of the January 1st date, you can see that there were 38 folks that were active in Tier 1, 19 that were active in Tier 2. So that's about 1/3 of your population that's earning at the lower benefit level. So over time, again, that you're going to have more of those Tier 2 folks coming into the fund, and that will bring down that normal cost over time for you. And then let's flip lastly to page 27, looking at that age and service distribution and focusing again on that bottom right quadrant there. Anybody that's already over age 50, already with 20 years of service, can retire right now. There's 9 folks in that category as of January 1st. That's 16% of the population. If we back that off 5 years and say who can retire within the next 5 years, there's 6 more folks. So a total of 15 people that can retire in the next 5 years. That's about 26% of your population. Again, not a very alarming number. That's pretty typical, or maybe even on the low end of some of the funds I see, where I've seen this number north of 50% before. So it can be a much more challenging place to be when you have a lot of retirements that could potentially come in the future. So with that, that's what I had with respect to the contribution calculations for police and fire pension funds. Are there any questions?
Any questions from any council members? Mike, did you have something?
No, it just every year I pick up and learn something new about the actuarial world and how that works, and it's just amazing to me. That 20 and 80% assumption part where talked about the death and dismemberment or disability.
So that's with respect to in line of duty versus not in line of duty. So there's different benefits that are delivered if you have a disability happen or a death happen while you're working in the line of duty versus whether it just happens outside of work. And so the reason we need an assumption for that is because the benefit structure will vary.
Okay, so when it says 20%, that refers to not that 20% of the people are going to get injured, but...
Right. So we have a separate table that determines the number of people that become disabled, and it's a much smaller number. And then of those folks, we divide them by 20% are called in line, or out of 20% in line of duty, 80% not in line of duty. And so we'll divide it that way, or vice versa. Actually, it's in line of duty, 80%, 20 not in line of duty. But we're splitting the very small disabilities that we already predict.
Okay.
And in the assumption section of the report, you can actually see a sampling of those rates, and you can see it's a very small percentage of the population in the first place.
Any other comments or questions? Do you want to continue with the report, or?
No, if
Okay.
everybody's done with me.
I know there were a few other pages, but basically they're a compilation of some, excuse me.
I did have a question, but more directed at Molly and Bob. How do we make the city's pension contributions? Are they done on an annual basis, monthly payroll, when taxes received from the county? How do we typically make our payments?
Yeah, as we get the distributions from the county, they are deposited directly into the police and fire pension funds bank account.
All right, thank you.
Any other questions, comments? Heidi, thank you very much.
Thank you.
Appreciate
Thank
it.
you so much.
Thank you. Okay, then we can move on to the third consideration for this evening's Committee of the Whole meeting, and that is a resumption of our 5-year financial plan, 2019 through 2023. I think we have had a couple of discussions on this in prior weeks, and I'll turn it over to our Finance Director / Interim City Manager, Molly Talkington.
Thanks, Mayor. Really, this is just more of an open item because there's a lot of information put together in that document that we went through at a higher level at the last budget workshop. So if there are outstanding questions, I can answer them, but also it's to remind you that that 5-year financial plan is more of an informational document. It's giving you the history and the economics environment that we're in, and provides lots of options for council to think about and consider. Nowhere in that plan is there a direct recommendation for you to make a change to any revenue or expenditure, but that is the basis for what I will be back with you in September at your next budget workshop to talk about those budget balancing measures, because we're using the financial forecast that's within the plan to show it shows that there's a structural imbalance for the city in our general fund, and that the revenue growth is just not keeping up with your expenditure growth. So it's that gap that we're seeing, about $1.6 million, that then I will come back to you at the next meeting so we can go over ways to kind of solve that gap, either through expenditure reductions, looking at revenues, or some combination of both, to get you that budget balancing figure that will solve where we are for the FY18, FY19 budgets, and then how that will project out through that 5-year plan. So tonight I don't have any information for you on that. We're still working on it. It's really why it's on here, is to tell you the departments have worked hard. They did get input from employees. We got union options. I even took some of the feedback we've gotten from council in different one-on-one meetings or things I've heard said at different meetings. So I tried to reach just about anyone possible to get input on what they would think would be something we should talk about with council as a budget balancing measure. I think we did get a lot of information, but now is just the time for me to go through, make sure the information is correct, because as much as everyone likes to turn in their budget figures and does a really good job of trying to estimate the dollar figures, I like to check that in finance. So I want to make sure you have the most accurate information.
I think the fact that, and I probably misspoke on the radio show the other day when I had indicated that we were going to get down to the brass tacks of starting to chop away at that 1.6 million deficit, and I think I knew where we were. I think we're caught up in something that is good, and that is the fact that we're so far ahead this year compared to where we were last year. I guess I was trying to jump the gun on that. And having been in this building virtually day after day, I know how hard department heads are looking at that general fund component piece and trying to look at that $1.6 million. And so I commend you, and I had asked you before the meeting to give us a review of where we were going to be, and Alderman Fagan reminded me, he said, well, it's in the report, and I guess I hadn't realized that it was in there, but I appreciate that. It's something that the average man on the street, the resident, the taxpayer, who perhaps doesn't follow these things as closely as we do and should, they don't look at those dates perhaps as closely as we do, and so I appreciate your efforts to keep us on track. And let me ask that question, it sort of leads to that question, from your vantage point, and I'll ask the council too, from your vantage point, are we where we want to be in terms of the coordination between Finance Advisory Committee, City Council, and staff for our budgeting process for 2019?
I believe so.
Good.
We've been meeting with FAC before we come to your budget workshops, asking them about the information, getting their feedback, questions. So far, I don't have any recommendations from FAC, but it could be, this has been a lot of information between the 5-year plan, the CAFR, the actuary reports that we're giving you. So there's a lot of stuff to digest and take time to understand. And then when we come back with those budget balancing measures, that's going to be the next step. I don't expect that we will have decisions at the next meeting because you need time to see them, digest them.
Mm-hmm.
You know, you can tell me, Molly, this one's a crazy idea, we don't even want to touch it, and then we will kind of take that one off the table for consideration. But that's what we're looking for, and we have some time between our September meeting and what I really believe is making those decisions by the time you get at your joint meeting with FAC early November. This is our working meetings. So when we get out of that joint meeting, we should be able to turn around with a proposed budget where you feel comfortable that you've discussed every item, that we've incorporated all the changes that you would like to make, that we've had multiple meetings where citizens can come and provide their input. And if they don't come to the meeting, they can more than welcome to call or send me an email or send, you know, the department head that, you know, if they have a public works idea, send it to the public works director. Maybe he hasn't thought about it, or it's some idea that we haven't had there. So there's time to get the feedback, which I think is where we were lacking last year. We felt rushed in getting that information put together.
Sometimes even those crazy ideas can result in something that is really substantive,
True.
something that is really good.
Right. And then the other thing, if you've noticed, and I've tried, on this one I put the whole schedule of what you've completed and then where you have kind of the next steps to go. But if you've started to notice in your regular reports to council, we've been putting more of that prior background information as hyperlinks. So it's easier if you've, you know, if it's been a few months before we've talked about it, there's something quick that you can access and then get refreshed to where you need to be. So we're trying to keep that kind of prior information at your fingertips as well.
Did you have a crazy idea, Alderman Noriko?
I always have crazy
Okay.
ideas, but no.
Please.
I know at one point we had talked about considering an amusement services tax, and I didn't see that on the list of options. I don't know if it would still be worth considering, discussing, if it would have any impact. I know that there were pluses and minuses, but every tax you mentioned in the report have pluses and minuses. So I'd kind of like to throw that out
That's
there
fine.
again.
I can add that back
Okay.
onto the list. But you're right, the revenues, I did some of your higher level ones. They're in this 5-year plan, you can see, and I tried to put in there that positive and negative effect of if you had to take action on one, what that would be. But we'll look at, we probably have the information, I just need to find it.
You know, I don't have a strong feeling about it now, but I remember it was one of the options we had looked at one point. So, thank you.
Any other comments or questions of Molly regarding our 5-year financial plan that we continue to look at, study, tweak, whatever? Thank you. Appreciate it.
Thank you.
With that, we have nothing else on the agenda. I would entertain a motion to adjourn this special committee of the whole meeting.
So moved.
Second.
Been moved and seconded. Any further discussion? All in favor say aye.
Aye.
We are adjourned.